A stuffed bear named Patti sold for $500,000 in 1998, not because it was rare, because everyone believed it would be worth more tomorrow. In the mid-1990s, Thai Inc. released small, bean-filled plush animals with a simple premise, limited production runs. Each Beanie Baby came with a hang tag, a birth date, and an expiration date, a retirement announcement. The company controlled supply carefully. When a design retired, it was gone. No restocks, no second chances. Here's what everyone believed at the time. Beanie Babies were investments, serious ones. Parents weren't buying them for kids to play with, they were buying them to hold, to protect, to flip. By 1998, secondary markets exploded. eBay listings showed retired bears selling for hundreds, then thousands of dollars. The accepted story goes like this: scarcity plus nostalgia equals value, limited supply, emotional attachment, perfect formula for a collectible market. Thai understood supply management better than anyone. They retired models at exactly the right moment, just as demand peaked. That's the explanation everyone repeated. But there's a problem with that story. Thai wasn't creating artificial scarcity out of thin air. They were responding to something they saw happening in the market. Collectors were already treating these toys like stocks before Thai leaned into the retirement strategy. The supply control didn't create the mania, it amplified something already burning underneath. What actually drove prices wasn't Thai's strategy, it was psychological. Collectors believed Beanie Babies would appreciate because other collectors had already paid high prices. Each sale became proof that the next one would be higher. It's called momentum, it's called herd behavior, it's the mechanism behind every bubble. Price guides emerged, not from Thai, from collectors themselves, publications dedicated entirely to Beanie Baby valuations. A bear worth $40 last month was now listed at $200. These guides weren't tracking real sales, they were predictions, guesses, but they looked authoritative, they looked like data. Here's where the real mechanism reveals itself. Most Beanie Baby sales weren't actually happening. They were listings, asking prices. Someone listed a bear for $5,000, it didn't sell. But the next person saw that listing and thought, well, someone's asking $5,000, so maybe mine is worth $4,500. The price was set by hope, not by actual transactions. By 1999, the secondary market had become its own economy. Collectors weren't buying Beanie Babies to enjoy them, they were buying to resell. The toy itself was irrelevant. What mattered was whether the next buyer would pay more. That's speculation. That's the exact mechanism that precedes every market collapse. Then Thai made a critical mistake. They announced they would retire the entire Beanie Baby line. Forever, production would end, everything would be gone. The company thought this would cement the value, the ultimate retirement announcement. Instead, it triggered panic selling. If Beanie Babies were actually scarce, the announcement shouldn't have mattered. True scarcity doesn't rely on continued belief, but this market was built entirely on the assumption that demand would stay high. Once collectors realized the party might end, everyone tried to exit simultaneously. The collapse was swift. Bears that sold for $500 in 1998 were listed for $5 by 2000, not because the bears changed, because the belief changed. The secondary market didn't exist to serve collectors who loved these toys. It existed to serve collectors who believed other collectors would pay more. What's crucial here is this: Thai Inc. didn't create a bubble through deception. They created it through supply control that triggered psychological mechanisms in collectors. The company understood the mechanism well enough to profit from it, but they couldn't control when the collective belief would break. The real cost of the Beanie Baby bubble wasn't borne by Thai. It was borne by collectors who bought at the peak. Families who spent thousands on plush toys expecting them to fund college tuitions. Investors who treated a children's toy like a municipal bond. This bubble teaches us something critical about how price works. Price isn't inherent to an object, it's a consensus. When consensus shifts, price collapses instantly. Beanie Babies had no intrinsic value, they were always worth whatever someone would pay. The market eventually realized there were no buyers left. The same mechanism would repeat in 2000 with dot-com stocks, in 2008 with housing, in 2017 with cryptocurrencies. The Beanie Baby bubble wasn't unique because it involved toys. It was unique because it was so visible, so obvious, so easy to track. A bubble where you could hold the evidence in your hands. Today, a few rare Beanie Babies do hold significant value. A first edition Patti sold for around $500,000 in recent years. But that's not because the market corrected and found true value. It's because a tiny subset of collectors still believe in the narrative. The bubble collapsed, but it never fully deflated. So when you ask why a Beanie Baby cost what it did at its peak, the answer isn't scarcity or nostalgia or Thai Inc.'s genius, it's collective belief. It's the moment when enough people agreed that tomorrow's buyer would pay more than today's. That agreement created a secondary market worth hundreds of millions. and that same agreement, when it evaporated, destroyed almost all of that value. This video is for educational and informational purposes only and is not financial advice. Always do your own research. Subscribe. Each week we dissect another financial mania that shaped markets and wallets, so you understand how bubbles form before they burst. This video is for educational and informational purposes only and is not financial advice. Always do your own research.